Assalamu alaikum. This is me, Dr. Saifullah, and I welcome you to the new video about financial modeling using Microsoft Excel. This is our sixth video where we are going to start financial modeling. In earlier videos, I have tried to introduce you Microsoft Excel. We have talked about different functions and Microsoft Excel features as well. And in this video, we will start learning about financial modeling. Before going into detail, we will start with financial model. A financial model is a mathematical model that represents the performance of a financial asset, project, or other investment in abstract form. It means we can use financial models to get some information about the performance of financial assets, project, or other investments in a short form or in a simple, ready-to-use form. There are some other views about financial model as well. Someone explained financial model as a financial model facilitates the forecasting of future financial performance by utilizing certain variables to estimate outcomes of specific financial decision. So this definition focuses that the financial model is basically a tool to estimate the outcome of a specific financial decisions. There is an other view about financial model as well. That is, the financial model facilitates decision making by presenting preferred course of action and their consequences based on the results of their calculations performed by the model. From these three definitions, we can conclude that a financial model is a tool that we can use to assess the performance of an asset, of a project, or of a company in a ready-to-use form that can facilitate in decision making. The financial model has basic three ingredients. These are investments. In investments, we normally evaluate the decisions related to purchasing new equipments or expansion of the business. The second main ingredients of financial model is financing decision. And in financing, we normally talk about the cost of finance, availability of finance, the risk inherent in the source, and the desired debt to equity ratio. And lastly, we have distribution, where we talk about the expectation of the shareholders, the need to retain surplus of future growth, and the desire to maintain a good dividend policy. In financial modeling, we normally talk about these three decisions. Normally, we can evaluate investments, we can avail financings from different sources, or we can decide about the distribution of the dividends, or either to retain them or either to distribute to the shareholders. And these can be easily performed by using a financial models. There are different type of financial models. Some models that we will discuss are the corporate finance, the time value of money. This is the basic topic of finance, where we will talk about the time value of money and its related calculations. We will normally calculate its present value, future value of cash flows. We will calculate internal rate of return, or we will perform different techniques to calculate interest or number of years and so on. These calculations will facilitate in building financial models. The second will be stock valuation, where we will talk about the corporate valuation overview, calculation of weighted average cost of capital, valuation based on the consolidated statements of cash flows, as well as we will also talk about financial analysis. The second model that we can create is about the portfolio model. In portfolio model, we will discuss about the portfolios, calculate the efficient portfolios, calculate the variance, calculate the variance covariance matrix, estimate betas, and draw the security market line, efficient portfolios without shortage, the Black-Litterman approach to portfolio optimization, as well as we will study event studies in portfolio models. The next topic is valuing bonds, and in bonds valuation, we will study duration, immunization strategies, modeling the term structure of interest rate, calculating default adjusted expected bond returns. And the next topic is valuation of options. And in valuation of options, we will study about its introduction, the binomial option pricing model, the Black-Scholes model, option Greeks, and real options. Then we will study Monte Carlo simulation method. Firstly, we will study its introduction. Then we will go for stimulating stock prices. Monte Carlo simulation for investment, value at risk, stimulating options and option strategies, using Monte Carlo method for option pricings. After that, we will study the mergers and acquisition model, where we will evaluate companies and decide about the mergers and acquisitions and apply different strategies to find that whether the firm should go for merger or acquisitions. The next topic will be about integrated financial statement model. In integrated financial statement model, we will create three financial statements: income statement, balance sheet, and cash flow statement, and prepare forecasted financial statements, build some assumptions, and select profit and loss account growth drivers, select balance sheet growth drivers, and forecast future financial statements by using these drivers. Then we will study about the ratio analysis, and we will evaluate a company by using its ratios. And in the last, we will talk about the Excel dashboard for the financial models. The Excel dashboard financial model is a dashboard that provides all related information on a single page that facilitates in decision making. The financial models can be built by following a certain steps. These steps include: the first step is design the high-end structure. Although we won't know the specific layout of the model until we begin constructing and computations, you should have a general understanding of the tabs. Organize the information you currently have into the broad categories listed in defining inputs, calculating, and output blocks to get started. The second step is designing output summaries, charts, and reports. Because you already know the problem that your financial model needs to solve, you should have an idea of what the answer might look like. By thinking about the output of your model, you will be more focused and will ensure that all your calculations work toward the desired results. The third step is designing inputs. In designing inputs, decide where the source data and the inputs will go. Set it up such that more information can be added later, even if you don't have it all at now. The fourth step is about starting calculations. Start by creating a tab called Workings or Calculations, but be aware that it will likely grow as the model develops. Link the formulas to your inputs, but don't try to tackle too many difficulties at once. Instead, split larger problems into smaller ones. The next step is connect outputs. Link the output page of your calculations. Charts are a fantastic tool for displaying and visualizing the results of your model. So based on the output of your model, you can decide that which thing you have to use. Either you have to use ratios or charts or something else. Next is add scenarios. You can include sensitivity and scenario analysis after the model is operating properly. And the most important is assumptions documentation. The majority of these stages are sequential, but it is never a good idea to leave assumptions document till the very end. Write assumptions as you do it. So that's all about the today's video. In the next section, we will talk about corporate finance, the time value of money. And if you have any questions about finance or financial modeling, you can contact us. We will try our best to provide you best answers. Thank you. Take care. Allah Hafiz.